Good afternoon and welcome to this web conference with Movinn in relation to the company's report for Q2 2022. The company is today represented by CEO Blok. My name is Jens Jacob Aabel Nordkvist and I work at Västra Hamnen Corporate Finance and I will be your moderator for today. We will, as usual, start with a presentation by the company, after which there will be a Q&A where all listeners have the opportunity to ask questions using either the question field on the right side of the screen or on the bottom of the screen, depending on the unit you are using. After you type your questions, I will read them aloud and the company will then proceed to answer them. Before I hand over to you, Patrick, I'd just like to say that this session is being recorded and that the recording will be available on Movinn's homepage and on Västra Hamnen Corporate Finance YouTube channel. So with that said, I give the word over to you, Patrick.
Thank you, Jens Jacob, for the introduction. Thank you for hosting this webinar. Another quarter has passed and another story to tell. We have been, I've put in a few bullets on the subheader just to kind of encompass some of the major themes that we've been working on. Again, we're displaying high double-digit growth. We've realized a 32% top line growth in the first 6 months of 2022. It is a profitable growth, also in line with what we've previously communicated in both in relations to when we did the IPO, but also kind of on the sessions we've been having so far in the earlier quarters. And another major theme for us, obviously, is that we are now executing on the international expansion, which is a major one. Super happy with that. It's been a learning experience, but it looks like that we are kind of it's all coming together quite well. So that's a major plus. Yeah, for those of you who do not know me yet, I'm the CEO. I was part of the team that launched Movinn back in 2014. I was promoted to managing director in 2017. I then spearheaded the IPO back in 2019, and now we're just executing on the promise and on the strategy that we kind of went out with back then, focusing heavily on keeping domestic growth rates attractive, but also executing on the international expansion, of course. I've highlighted a few points from our CEO message. Again, top line growth of 32%. We're also improving on fundamentals in general. So we have our EBITDA margins are improving. We realized a 12.7% margin for the first half of the year, and the EBIT margins is as well improving, with a realized EBIT margin of 4.6%. We have added 50 units in H1 in Denmark alone, which is a fairly steep growth rate. We are guiding on 60 for the full year, so 50 in the first half of the year is a decent number. We've also added 33 units in Malmö, which takes the total up to 83. So we are not bored at all at the moment, that's for sure. We have secured the domestic pipeline as well. It's been oversubscribed, if we to use that sort of term, by 115%, which is also great. Shows that the market that we are able to keep the growth rate that we both promised, but also kind of that we can keep sourcing the attractive units and being relevant to both our real estate partners, but also our clients, of course. So that's a positive factor. The full year effect on the pipeline will not materialize this year, but it will in the coming year. So that's should give us a good starting point going into 2023. We've executed on the first launch, international launch in Malmö, which is great. It also sends a signal that we are able to create the network and cultivate the networks both on the real estate side, but also with the clients. So that's something that we're very happy with. We've also reached a critical mass now, meaning that we now have a substantial unit number in the region. Since we did our H1 publication in late August, and until now we've also communicated our second launch in Sweden in Lund. So we're pretty well covered in 2 key markets in the southern part of the country, which is fantastic. Great partners, great reception by the clients. We're very positive about that. We're obviously monitoring the effects of some of the larger macroeconomic themes that are ongoing right now. We have the inflation rates that are way above normal. We have rising energy costs. There's also some. We also have some factors that are non-systemic or kind of that are affecting us, and we have some currency fluctuations that we're also starting to monitor. A new field of our risk management, and also some bottlenecks in the shipping lanes that we still kind of see. It looks like it's easing up, but it's still a factor. The general demand is strong across all markets, so that is obviously a positive factor, and it's a key assumption on our future growth perspective that the demand levels keep being both stable or even better, increasing. To recap on the business model very quickly, Movinn has a very a relatively asset-light business model. We don't own any real estate ourselves, meaning that our balance sheet is fairly slim. That's the one thing, and the next thing is that we have this subscription logic to our cash flows, meaning that the clients that we have, they are with us for a good amount of time, meaning that we're not out selling every month. We have a pretty good opportunity to both be scalable and to have some fairly stable cash flows in the midterm. But again, we do partnerships with real estate owners, and we then make the property ready for this plug-and-play serviced living product that we offer. Then we do kind of large bulk rentals, mainly to B2B clients, and then the residents gets a lot of service and a lot of convenience and a lot of flexibility, and that's kind of part of the value proposition that we do. It's fairly popular, and it doesn't look like it's going to get less popular anytime soon. Our current presence, it looks, it has been developed by our first international launch in Malmö. We have a pretty good coverage in Denmark already. We had so on last year as well when we kind of listed the company. As mentioned earlier, we have also added Lund to our geographic coverage, meaning that 2 of the important markets in Skåne is well covered by now, which is great. We are managing everything from Copenhagen still. So we are, of course, we have people on the ground, but all the kind of critical functions are being managed from the headquarters in Copenhagen. That's why we have the weird lines between the bubbles, so to say. A key ingredient to doing this remote control operations is to have a lot of technology and a lot of sound technological infrastructure, both in hardware but also in software products. And since we started Movinn, it's always been part of our philosophy that we wanted to develop tech products in-house, and we keep doing so. We've been upping our tech capabilities a lot this year. We have our IoT product, which is the access system that you can see in the picture to the right side of the screen, and we also have a lot of software products to tie everything together. And then we have our platforms, obviously. So all the products and all the things that the clients are seeing is something we develop. Everything is developed in-house. We keep adding to the functionality. We keep adding new product lines. Most recently, we did the co-living thing, which has been a great supplement to our core business, and we're looking to explore synergies from our existing operations even further. And having this resource in-house allows us to be very quick and agile on this point. Another thing that a strategic thing that we decided doing a couple of years ago was to develop our own furniture brand, our own furniture items in-house. We did so because we wanted to limit our investments going forward. We wanted to eliminate any middle links in the supply chain. This gives us more control. It also allows us to keep quality both looking and feeling extremely high, but at a price point that is still attractive going forward to limit our ongoing investments. Also, when if the FF&E will start to kind of deteriorate and needing to be replaced, the reinvestment need should also be fairly lower than it was in the beginning of our life cycle. I've brought the highlights from the P&L and the balance sheet. I've highlighted a few. One of the major ones is that we have improved dramatically on our bottom line metrics. So our EBIT is way improved, and we're happy about that, obviously. Also, kind of balancing the growth and the bottom line is something that is a bit tricky. It's not because growth will tear on your bottom line. That's just how it is. So balancing those two out is also something that we are trying to manage, and in all modesty, I think we've done it fairly well. I have highlighted our depreciations in yellow. We can come back to that later, but that is to direct attention to the fact that we have some more depreciations than we initially thought when we did our forecasting. On the plus side, it looks like that our FF&E lifespan, some of the early investments we did are starting to get they're completely written off starting from next year. So, and it looks like that the lifespan of those investments still have a good way to go. So that's a positive fact, and it will it should set at a level going forward. That being said, investing if you look to the right and from the cash flow statement, you can see that we've invested 6.6 million in the first half of the year, and having so high an investment activity that will just create depreciations. There's no way around it. Another thing I would like to highlight is the fact that we are deploying our cash fairly wisely, I would say, and we are being a bit conservative with it. But if you go back and to the stage of the IPO, we did a net raise in capital after costs of 25 million Danish. And we have deployed 5 of those million in kind of net cash since then. We've done a full commercial launch in Sweden, and we've also started to lay the groundworks in Germany, doing a lot of preparations on that. So those two important kind of goals have been achieved, and Germany will get achieved. And the last thing is that we're also supporting the domestic growth, obviously, with an investment need. So the cash flow from operations is positive and fairly strong, and the investments are being deployed in growth more or less completely, I would say. So that's a good one. We also display the metrics and the operational data. I've highlighted a few. The ones in greens, they are, when we come a bit further, they are linked to the guidance. The ones in yellow, they are a bit below the guidance levels, but metrics are improving. We're also starting to disclose more data than we've done historically. We are isolating Denmark, the Danish operations alone. That's because those are the figures that have been guided on in the annual report. So those are isolated to show the development here. Then we have the group that is including the Swedish subsidiary. There is a bit of a cash burn, has been a bit of a cash burn in the Swedish subsidiaries. That's mainly on kind of legal advice, advisor costs, a bit of timing stuff with having the units and then getting them out into the market. There's also a bit of a delay in that fact, but all in all, it's going well, and we're positive. And the last thing is that we've isolated the Q2 on its own, just to display how the development is also going on in the quarter in an isolated way. And again, you can see that the EBITDA from operations, the metrics are improving. It's up from 9.1 to 12.7. Pretty good improvement. EBIT margins are up. No plats and return on invested capital are up. Obviously, we've also it's up for the half year, and it's even better for the second quarter isolated. So that's a positive circumstance as well. We're also managing our financial metrics in very actively. So our quick ratios, our equity ratios is something that we are keeping an eye on. So we need the ability to remain financially strong, even though we service debt and repay debt and those things. So in general, we are not burning through cash. We're deploying it wisely, and the existing operations is a very strong foundation on which we can build and launch international subsidiaries. So that's so we're happy with that. The last thing is the operational data. As you can see, we've added 50 units in Denmark alone in the first part of the year. That is a 7% total change, total increase. If you remember the guidance from earlier on, we were guiding on 60 to 65 units, and we've already realized 50. If you look on the group, we have realized a growth of 28% in total, adding 83 units. So that's pretty substantial, and we will keep doing so, and we won't kind of ease up, obviously. Revenue per unit is also in the green, and so is the vacancy. So in general, we have steep growth and improvement on all the fundamental metrics that are kind of driving the value from our investment case in general. The pipeline is also something that we display. The pipeline is showing what kind of larger projects are coming in. It's also showing if there's some projects that needs to be, or larger bulk of apartments that has to be renegotiated, and it also shows if we have to hand something back. And as you can see, for the foreseeable future, there won't be any handbacks, which is great. If we were to hand units back to the landlord, we would then have to go out and increase our net inflow of units even more. So it gives us a good kind of stable foundation that we can just keep at units and not having to return any units in the foreseeable future. So that's good. It's been 115% secured. That's also why we are upping our guidance on the unit numbers end of year. And of course, we are not sitting back. We are in constant talks with partners both in Denmark but also abroad, in particularly, hoping to boost this even further. That's all. Not everything is rosy, of course. We are in a macroeconomic climate that is where there are some like major themes being discussed ongoingly. Some of them are systemic, and some of them are a bit more kind of business prone. One of the systemic ones and the major theme, obviously, is inflation. Close to double-digit inflation numbers is not something we've seen for, I think it's 40 years now or so. So that is above the normal. The impact on Movinn as a business is that our rent levels that we pay, both on the units but also on the offices and whatever, is also rising because real estate has inflation protection built into it. We are managing this by dynamically changing our pricing so that we can offset the cost that we are facing with the prices we charge, so the two go together, so to say. This means that we should be able to maintain our margins in going forward. So we are able to transfer some of it. We are not transferring it all because, in general, we think that we'll be facing some long-term challenges if we get too aggressive with the pricing, and we think that will have some elasticity on the demand that will hurt us in the long run. So we are changing it in a way that we can maintain our margins, but we're not kind of overstaying our welcome, so to say. We have a bit of the US dollar as the currency thing is a new thing for us to monitor. The US dollar has been fairly stable below 7. Now it's on 7.5. The impact is that some of the production lines that we have in Asia, for example, we have costs are increasing when you transfer it to Danish kroner because you pay in US dollar. So that is how it is. we're trying to renegotiate with the factories, because obviously for them this is 100% arbitrage, having the currency in their favor. So we might be able to squeeze that a bit. As I've mentioned, we could also engage in currency trading, but that might be punching above our weight. So I don't think we'll be doing that anytime soon. We'll stick to having trying to renegotiate with our factories. Energy prices, this is one of the systemic ones. Obviously, we have some variable costs that will be impacted on this. We have in the lower end of the scale, we have just like basic transportation. Our fleet of cars will be more pricey to have running, but also our variable costs, where we have our electricity bills, will be increasing. We are also able to kind of transfer the difference on to the clients. This is something that we do dynamically, but there is some stickiness to this, and that is because when people enter an agreement with us, they pay a fixed price. We won't come back and create any nasty surprises for them. This is a big part of our value proposition. This is a big part of what kind of makes us completely different from what they're used to, just having total foreseeability in their cost structure. But we are changing it dynamically and monitoring it, so we will offset any stickiness in that might occur from here. Again, earlier in the year, it kind of took us a bit back. We are managing this we're doing two things. One is to transfer or dynamically change the price to kind of match the current levels of energy, or what you pay for a kilowatt hour. The next one is that we thought we were super clever when a couple of years ago we started to buy all our electricity from renewable energy sources, so windmills and all that. So early in the year, when energy prices was also a theme, we had a chat with Ørsted, the major Danish energy company, and they said to us that when you buy wind power, you're not as affected as if you get your power from like plants that are fueled with gas or whatever. So we were happy with that until the prices still rose anyway. So they're not rising as dramatically as if you were buying power from gas sources or similar, but they are on the rise. The last thing is bottlenecks. This has also been a theme since the COVID crisis. There's longer lead times in shipping. It's not a major issue because it's fairly easy to manage, because we can just buy larger bulks of items when we order, and we are doing so. We are buying a higher minimum order quantities than normal, and so that has obviously benefits and downsides. The downside is that we're tying up more working capital in the short run, but in the long run, having all the bits and bobs we need to keep growing is obviously the most important thing, because otherwise that would be a stopping factor. If it's very critical and we are unable to source an item, we can then source a local replacement instead. So it's not a stopping factor. It just takes a bit more planning ahead. Remembering the guidance from 2022 in the annual report, we are revising our portfolio growth upwards. We are meaning that we are sourcing more units than we expected going into the year. Our revenue guidance remain unchanged, and one could easily ask, how can that be? And that's because the added unit number comes in fairly late in the year, so the full year effect of the units coming in will not have an impact in this year, but it should give us a better starting point in 2023. So that's why the revenue guidance remain unchanged in the current year. The EBITDA guidance remain unchanged as well. The EBIT guidance is being revised downwards. That's because that's due to our level of depreciations. We have more depreciations than we anticipated. We have underestimated some write-offs we have in goodwill. That's from the company we bought last year. So it's a mistake on our part, you can say, if one has to be completely honest. The next thing is that we are also investing more in tech. We're also investing more in For example, when you're buying more items from your factories, you are just committing more cash to that fact in the short run. So that's also part of the explanation. The new markets is unchanged. We've done a guidance is 1 to 2 new markets a year. We've done a full launch in Malmö. We also, since we published our H1, we've also been successfully launching in Lund. We'll be doing that here in October. So that is 2 very important markets in Sweden that we are now covering, which we are obviously super happy with. And also the cost of debt remains unchanged. This is a bit geeky, but if someone likes to do, WACC calculations and all that, then cost of debt is a fact that is a data point that you would like to know. It's a bit higher in our H1, but that's due to the fact that we changed banks and did a lot of stuff, which incurred some one-off costs in our financial items. This is the roadmap to 2025. We've been over this a couple of times. This is the long-term value driver guidance. This is the only long-term guidance that we offer. We don't do short-term earnings guidance, or we do short-term earnings guidance, but we don't do long-term earnings guidance because it, to us, makes no sense to do so. There's too many externalities. But the value driver guidance is something that we can be measured against, and as something that we obviously are very keen on delivering on. And the 20% compounded annual growth in units in domestic markets is one of them. This is one of those who has been revised upwards this year. We have the unit metrics. One apartment is expected to deliver a revenue of 180 to 225 per unit. We need the vacancy to be below 10. We want to do 1 to 2 new markets every year, so that we can keep upping our international expansion. We want our EBITDA margins to be above 15 in the long run guidance, and the returns is also expected to climb above 18% in the long-term guidance. And kind of tracking the progress from H1 to that long-term guidance, I've marked the ones in green. Those are the ones that we have delivered on. The yellow ones are improving, but it's still below target. So obviously, the fundamentals or the bottom line metrics, they will be fatigued a bit with growth, but we are doing what we can to kind of increase our effectiveness and our capacity costs so that we can climb above the guided target ASAP. But again, the unit growth, we've delivered on that. We are delivering on the revenue. We're delivering on vacancy. We are delivering on new markets. New markets is obviously a major one for us. So that's it should be, I don't know, dark green or blinking or whatever. It's super important. And the bottom line metrics, the EBITDA margin and the return is climbing in an upwards direction, and hopefully we can get those in the green as well. So again, we've done the 2 markets in the south of Sweden. We are now looking at Stockholm and Göteborg, and we're also working very intensely in Germany, where there's a lot of interesting cities for us as well. So this was my State of the Union for you. Hopefully you enjoyed it. Please feel free to ask any questions.
Brilliant. Thank you, Patrick, for that. So just now we're entering the Q&A. I'd just like to remind everyone who's listening that you can ask questions using either the question panel on the right side of the screen or on the bottom of the screen, depending on the unit you are using. While you write your questions, I thought I'd kick this Q&A off with a question of my own. So Patrick, I thought I'd press you a little bit on maybe when you expect the launch units in Malmö to be fully operational. You mentioned the revenue from them isn't really there during 2022. Do you expect that to be like in Q1 2023, or will that be an even longer process than that? Do you know that as of right now?
Yes, I do. Yes, I do. We had a very good. Again, what we kind of promised when we did the IPO was that we had a good existing network of international clients, where we obviously, when doing our homework before entering a new market, we have a chat with those with our existing international clients to kind of get a feeling for where they have any need that we could help them solve. And we have kind of utilized that network, and we're already renting a lot of units out. So it's working in the right direction. We have had some we have a good reception from the local companies and partners, but we're also fairly good at utilizing our existing network of large international clients. So we are already starting to see revenue, and we expect in the coming months we expect to be more or less at full force, you know, so that the launch will go into more normal operations where we will see normal vacancy rates and the normal churn. So it is my expectations that maybe at the end of Q3, maybe early Q4, that we will be in normal operations with the units we already have in existence, and that is including the ones in Lund that they will be launched here in October, and then we will obviously begin the operating process ASAP after that. And we've already kind of kick-started it by doing all the initial exercises with our existing clients. So all in all, we expect to be close to normal operations in late Q3, early Q4.
Sounds very promising. And just staying with that a little bit, I was wondering if you mentioned in the report as well some competition on the Swedish market. It's a new market, more other competitors, I assume, than maybe in the Danish. I was wondering if you have any comments on maybe how competitive the the Swedish market is compared to the Danish market, and if maybe as a result of that, if the profitability levels that you expect are sort of the same for both markets.
Yeah, good question. It's fairly competitive, I would say. We've obviously done kind of tried to tailor the concept a bit to match the local competitive environment. We have a major thing that our competitors don't do is that they don't really, there's no like larger player that are offering any options to private clients, and so we've done that as a competitive edge. Our pricing will always the pricing will always be very attractive. Like you can compare it to an introductory price, but the current price points we have launched with will still allow us to do the margins that we want to do. As we then gain better kind of coverage and better you know, where the clients get to know us a bit better, the local clients, we will and then kind of see all the stuff that we can do. We will be able to improve on that ongoingly, of course. But the important thing in an introductory phase is to get a very good start, very good kind of market knowledge, and then go out with attractive price points and attractive terms, and that's what we're doing, and we've been very well received so far. But we should be able to do the, obviously having a 33 units, which is currently there's a bit more in Malmö, but if we stick to the H1, having 33 is we can take way more, you know. So there will be, before you get that the effect of the leverage, you know, the leverage on your volumes, you will obviously run below par. But for us, the most important thing is that we reach our break-even point as soon as possible. If the current trend continues, I believe we'll be at our break-even point going into next year already. So in the perfect world, we won't be burning anything in Sweden from 2023 and onwards. And that's kind of our first important task, because that allows them to have the Danish operations. They can perform the bottom line, they can create a cash flow. If Sweden is on break even, then we can build it from there. So that's an attractive place to be, in my opinion.
Yeah, very much so. And also, if we you've just done your first international launch, but I'm excited to hear about the one coming after. You mentioned Germany a little bit as well, and a few cities in Germany, and also expanding perhaps to a fourth city in Denmark. So when you're looking for new cities, what factors are you considering the most, or do you think are the most important when assessing these new cities? Because even though a potential launch is, I guess, some time away in time. The preparation work has to start quite a bit before that. So what factors do you guys consider?
Yeah, for sure. Let's use Germany as an example. We are already doing the initial exercises in Germany. We've hired advisor teams. We've engaged in talks with potential relevant future partners, looking at a few projects. Again, there's like a two-side thing of it. There's the demand side and the supply side. Going into the demand side, you do this. It's this fairly, analytical approach, kind of trying to pin down a price point. The way we've always done it is to try to pin a price point, and then if we can be at par or below, then we should be fine in theory. And the other thing is obviously the demand side. So going into what kind of clientele is there? Do we know some of the clients already that are present? If so, then it's a major plus, because they know us for, if we've had let's say we've had a relationship with a client in Denmark for 8 years or so. They know us for what we stand for and what we can deliver. So getting the market penetration with a client that you've already had an 8-year relationship with should give you a head start, on your demand side. So that's obviously a major thing for us. But in general, it's big cities, a good diversification of industries. If we take Germany, there's the usual suspects. There's the Frankfurt, very heavily driven by the finance sector. Major, huge demand from there. With finance comes a lot of other stuff, a lot of sub industries as well. Seed markets and whatnot. The IT. If you look at a city like Hamburg, you have the major like kind of logistical stuff happening. It's the 7th largest port in the world, I think it is. A lot of our Danish clients have major headquarters in Hamburg, which is a plus. Berlin, obviously, Munich. Those are the kind of cities that we like. So large cities with a large presence of different industries that can kind of help diversify our demand, but also drive demand, obviously.
Right. Brilliant. Moving on now more to the unit numbers. It was an impressive upward revision for the number of units for 2022. I was just curious though, you have the organic growth in Denmark of 20% CAGR defined. But will this upward revision, because the CAGR for 2022 compared to 2021 will be a lot higher than 20% now, has that kind of affected 2023's pipeline? Are those units that have been added in 2022, were they sort of part of 2023's pipeline, or do you still expect to be able to add enough units in 2023 to reach your 20% CAGR target?
We will reach. We are going for after the 20%. We won't take any. If we overperform in year one, we won't use that as an excuse for not perform in year two. So next year we are going for the 20% CAGR for sure as a minimum.
Good, brilliant. Turning to the personnel costs, they were, I think, somewhere around 300,000 Danish kroner higher than in Q1, in Q2, and I was just wondering, have you increased the number of employees during the quarter in Q2, and how many employees does Movinn employ as of the end of Q2?
We have 34 on staff.
Okay.
We've added some part-time positions. We've upped our presence in both Odense and Aarhus. Again, if you just take having all these markets up and running that we have, it allows us to kind of grow in parallel. So what is driving demand in Aarhus might not be the same that is driving demand in Copenhagen. So we've upped the units in Odense. We've doubled the number. That'll take a bit more manpower to kind of be so that we know that we can both put the units into operations, but also service the existing clients and give them a great experience, because in the end, that's what matters. We've also part of the explanation on our wages. We have pretty good amount of people that are on part-time payrolls. So when activity is up, we will have a some costs that are also variable, but we're treating everything like wage costs. But from like a technical standpoint, a lot of the employees are part-time employees, and when activities are higher, or if you add a 50 unit here and 30 units there, you will be looking at burning some more hours than you. But again, that's one part of the explanation. And the other part is that we're also preparing and getting ready to keep growing. And so there will always be this, chicken and the egg thing going on. What do you do first? Do you just grow without looking back, or do you kind of try to consolidate and kind of also be able to support what you have existingly, but also have the manpower enough to keep growing? And there will always be this kind of mismatch between the two. And if you compare it with our wage levels last year, which is also up, that's mainly due to the fact that we've upped everything, we've professionalized everything. So we have a professional CFO now that we didn't have last year, and we also have a professional board in place that we didn't have last year. And unfortunately, they don't work for free. The good thing is that you don't need more board members. You don't need to add another CFO. So the current kind of executive management team can, in theory, we can add, I don't know, 500 units before we need any power in that part of the organization.
Yeah.
And lastly, just to also, if we talk about the future, we've also hired a director in Sweden, which we are super happy with. It was on paper, it's a great hire. She will start on October, based in Stockholm. So we'll be looking at we're very kind of zoning in on the Stockholm region. But a great hire on paper, and she will obviously also incur wage costs, but the operations in Sweden, the growth we can achieve, and it also looks like the demand is with us. So we're fairly certain that we can keep it in the break-even region, not for the full year, but going into next year, we will probably be able to support the local operations from the existing unit portfolio.
Right, sounds promising. I'm getting to the end of my questions now, so I'd just like to remind everyone who's listening that if you have a question you'd like to ask Patrick and Movinn, then please do so now. I'll read my last question out loud, anyways. It's more of a broad one, and it's more pertaining to your guidance for the revenue per unit. You have a interval of between 180,000 and 220,000 Danish kroner. And I was just wondering how could you reach the upper intervals of that interval? And you talk about adding additional revenue streams, but yeah, if you just have any comments on how you plan to reach that, because that could be when you're focusing on more perhaps margins over growth, and that could be quite an important factor for you.
Yeah, you're totally right. You're totally right. It's the revenue per unit is a bit of a dark box number, to be totally honest, because say that now we're reporting on an H1, and 33 of the 50 units came in Q2, so that they don't even have like a full half year effect yet. So in the perfect world, if I could do a deal with someone in January where I add 80 units to my portfolio, and then I don't have to do anything else, then I can get the full year effect of the 80 units in January, and everybody would be happy, and our margins will look super attractive. In the real world, it's more of a trickle thing. It's more linear. So one of the explanations is that if unit comes in late in the quarter, then they won't have an effect in that quarter. They will not. They will show in the next quarter. That's one explanation. The next one is that obviously vacancy rates. If we keep our vacancy rates low, then we will be able to create more effective revenue per unit. So that's what we are that's the magic you need, so you can deliver, but you don't want too much vacancy. So how do you reach a good point there? And the last thing is that from a risk standpoint, smaller units obviously create lower revenue per unit, than larger units do, but smaller units are way easier to keep rented out effectively than larger units. So there's also like a risk management thing. If we add a lot of small units, that might have a downward pressure on the revenue per unit, but from a risk standpoint, it's way better than having a lot of.
Right.
So I hope that answered the question. And again, I think what I said to begin with, in the perfect world, I would sign 80 units in January and then just operate them, and then I'll show you. Then you would be able to see how they could perform, totally consolidated without any tear on margins or anything like that. That would be an exercise. Hopefully we'll get to that at one point. And we are working on larger projects now. It is because we are able to do so. Our cash flow is strong, and we have the firepower to do it. So we are. That's why the pipeline is so important to us, that we can plan that efficiently.
Right. Exactly. Yeah, very much looking forward to the fully operational launch of Malmö and Lund as well. We have no further questions from the audience, and you've answered my questions very well, Patrick. So I think it's time to round off. Thank you very much for your time and for the presentation.
Thank you, Jens Jacob. As always, have a good day. Thank you for listening in.